Hey traders, in today's video we'll be going over an RSI divergence trading strategy. Let's get into it. Here we have a chart where price is moving down as selling pressure is coming into the market. This downwards move on the price chart is mirrored fairly closely on the RSI, as the RSI line moves down too. We see a small pullback in price which stops short at a level of resistance. Again, we see this movement mirrored on the RSI. Next we see another push down from price, which moves below the previous low. So price has made a low here, followed by a lower low. But if we match these price swings up with what happened on the RSI during that same period of time, we can see that there is a difference. Price made a low, followed by a lower low, but the RSI made a low, followed by a higher low. This is an example of bullish divergence, and it can often result in some great buy trade opportunities. However, there are a few rules we need to follow to ensure we're taking only high probability divergence trades. Not every divergence you see on the chart is created equal, and we want to make sure we're only looking for the best trade opportunities. Here we have a move up from price, a retracement, and another move up. You can see similar movement mirrored on the RSI, with a move up, a retracement, and then another move up. Now again, let's match up the price swings with the RSI. So price made a high, followed by a higher high. But looking at the RSI during this same period of time, we see a high followed by a lower high. This is an example of bearish divergence, where price made a higher high, but the RSI was unable to make a higher high. And these kinds of patterns can often result in great sell trade opportunities. So the number one mistake I see people making when taking divergence trades is that they don't wait for the RSI to hit an extreme first. If I zoom in on the RSI, you'll see these dotted lines at the top and bottom of the indicator. The top dotted line is called the upper band, and it represents when the RSI is moving into an overbought area. And the bottom dotted line is called the lower band, and it represents when the RSI is moving into an oversold area. I'll put the current settings for the upper and lower bands on the screen now, but you may wish to use slightly different settings depending on the market you're trading. So here's a rule I use when looking for divergence trades. I don't consider divergence valid unless the RSI moved into the overbought or oversold region on the first price swing. This means that if you're looking to take a divergence buy trade, you need to see the RSI become oversold. And if you're looking to take a divergence sell trade, you need to see the RSI become overbought. Here you can see we have a bullish divergence between price and the RSI. On the first swing down, the RSI moved into the oversold region, which makes this a valid divergence trade. Here we have a similar situation with a bullish divergence occurring between price and the RSI. However, in this example, on the first swing down, the RSI did not move into the oversold region, so this would not have been a valid divergence trade. Even though technically there is a divergence between price and the RSI, because this divergence didn't occur in the overbought or oversold region of the RSI, I would not count it as a valid trade. Here we can see that price has made a high, and we saw a very shallow pullback of just a single red candle, before price continued upwards and made a higher high. So although price made a higher high, our RSI made a lower high, which is an example of bearish divergence. So while it may be tempting to take a sell trade here, I would actually classify this as a low probability divergence trade. The reason for this is because we didn't see a significant enough pullback between the two highs in price. This is something that you'll see quite often in strong trends. Price making a high and then only a very shallow pullback before buyers step in again and a new high is made. So in this kind of situation, even though there is technically a divergence between price and the RSI, you would be better off skipping these kinds of trades. Here's an example of a much higher quality divergence trade. Price makes a high here and the RSI moves into the overbought region. We see a pullback in price and then another move up, making a higher high. The RSI on the other hand makes a lower high, making this another example of bearish divergence. But if we compare this example to the previous one we just went over, you'll notice that the pullback we saw from price was much more significant. I recommend avoiding the kind of divergence trades that you see on the left, where we see only a very shallow pullback. Here we have a trade example that fits the two criteria we talked about for a high quality divergence trade. Number 1, the RSI has moved down into the oversold region. And number 2, we saw a deep enough pullback between the first price swing and the second price swing. This is a great example of bullish divergence, but there's one more aspect to this trade which makes it an even better opportunity. If we zoom out on this chart, you'll notice that the divergence is occurring at a level of support. This is the level which caused this significant price move to the upside. So by combining this strong level of support with the bullish divergence between price and the RSI, we are able to increase the probability of this trade. We can also use this technique with other areas of value. So we have a low in price here, we see a pullback, and then price goes down and makes a lower low. The RSI, on the other hand, makes a low followed by a higher low. But in this example, instead of using a level of support or resistance to increase the probability of this trade, we can use a trend line instead. So we have a swing low in price happening here, here, and here. If we connect these 3 points with a trend line, you'll notice that the divergence between price and the RSI is happening in contact with the trend line. And then soon after we see a reversal as price continues higher from there. There's never a 100% guarantee that divergence will result in a reversal from price. But by combining divergence with other forms of analysis, such as trend lines or support and resistance, we'll be able to increase the probabilities of those trades. So we've talked about using divergence to take trade opportunities when price reverses and goes the opposite direction. This is the standard type of divergence, but there's actually an additional type of divergence we can use to take trades in line with the overall direction of the trend. So instead of using divergence to look for a reversal trade opportunity, we can use it to look for a trend continuation opportunity. Notice here as price starts to move up and form higher lows, the RSI line is also following the same pattern. However, here price made a low followed by a higher low. But if we look at what the RSI line did during that same period of time, we can see that it made a low followed by a lower low. So we have a situation where price is making a low followed by a higher low, but the RSI is making a low followed by a lower low. This is something called hidden divergence. It's different to the regular kind of divergence because we can use it to help find trend continuation opportunities. Here we have an example of hidden divergence on the sell side. So looking at the price chart, we have a high followed by a lower high and another lower high. But looking at the RSI on the other hand, we saw a high followed by a lower high and then a higher high. So between these two price swings, we saw an example of hidden divergence. We have a high followed by a lower high in price, but we have a high followed by a higher high on the RSI. So we would use this to help us find a sell trade in line with the direction of the trend. So as you can see, hidden divergence is different because it allows us to take trend continuation trades, as opposed to regular divergence, which allows us to take reversal trades. It's worth knowing how both of these types of divergence work because it will give you more flexibility in your trading approach, which means it will be easier to find more trading opportunities. If you enjoyed today's video, then please leave a like below as it really helps the channel out. Happy trading!